All right, let's get right into it. Today, we're dissecting a really wild story from the stock market, all about a small tech company called VerifyMe. And trust me, for them, one single day changed absolutely everything.
And yeah, this is the moment it happened. On January 5th, 2026, VerifyMe stock, ticker symbol VRME, didn't just go up, it exploded. We're talking a nearly 58% jump in a single day. You see a move like that, and you just have to stop and ask. So, that's the big question, right? What in the world could make a stock shoot up that high, that fast? I mean, this is not your everyday market fluctuation. Something major had to be going on behind the scenes.
And it turns out, the answer wasn't some revolutionary new gadget or a surprise earnings beat. No, the catalyst was something way more dramatic. A lifeline, really, that came in the form of a merger.
Boom! The news drops that VerifyMe is doing a transformative merger with a company called OpenWorld, a pretty big name in the token economy and blockchain space. The market's reaction? It was instant. It was huge. This told everyone that VerifyMe was trying to completely change its story from a struggling little tech firm to a potential player in the booming world of blockchain.
So what even is a strategic merger? Well, think of it like this. It's when two companies decide that 1 + 1 could actually equal 3. The market usually gets excited about this stuff because of something called synergies. You know, combining tech, cutting down on costs, and hopefully creating a single company that's way stronger than either one was on its own.
But here's the thing. This wasn't just some smart business deal. For VerifyMe, this merger was, well, it was everything. To really understand why this news caused such a massive explosion, you have to see what was going on just a few weeks before. It's pretty dramatic.
Because you see, before the stock was soaring, it was actually sinking fast. The company was in some serious trouble. They were basically staring right over the edge of a cliff. Okay, a little bit of context first. VerifyMe is what we call a micro-cap stock. The best way to think about it is this. If the stock market is a giant ocean, a huge company like Apple is a massive cruise ship. It's stable, it turns slowly. A micro-cap like VerifyMe, it's a tiny little speedboat. Yeah, it can go super fast, but it can also get totally swamped by the tiniest waves. It's a high-risk game, for sure.
And this timeline just shows you how rough the water was for them. In November, they put out some kind of meh financial results. Then, in December, the hammer drops. They get an official delisting warning from NASDAQ. They were literally about to get kicked off the exchange. And then, just in the nick of time, that merger gets announced, the stock skyrockets, and they're saved at the very last second.
And see, that's the key. There's this rule on the NASDAQ exchange. Your stock has to trade for at least $1 a share to stay listed. VerifyMe had dipped below that buck, and it stayed there long enough to trigger the warning. Getting delisted is a disaster for a public company. It destroys your credibility, and it makes it way harder to raise money. So this merger news didn't just promise a brighter future, it solved an immediate life-or-death crisis.
Okay, so we've got the financial drama down. But what does VerifyMe actually do? You gotta understand their business to see the whole picture here.
The company really has two main jobs. The first is authentication. That's all about making sure products are the real deal, protecting brands from fakes. The second is precision logistics, which is a fancy way of saying they track important stuff to make sure it gets where it needs to go, safe and sound.
So how do they pull this off? Well, for the anti-counterfeit stuff, they use cool tech like invisible inks and special secure QR codes. And for the logistics side, they have this platform called PeriTrack. It's pretty neat. It's made to track things that are sensitive to time and temperature. So think about critical medicines or fresh food that can't get too warm or sit around too long.
So what do we have? A company with some interesting tech, saved from disaster by a huge merger. What happens next? Well, this is where it gets really complicated, because you've got some very good signs and some very concerning ones all mixed together.
When you look at their finances, it's like reading two completely different stories at the same time. The good news? They've got more cash in the bank than they have total debt. That's a nice safety cushion to have. But the bad news is pretty big. They're not profitable, and their sales have actually been shrinking. A merger doesn't just magically fix that overnight.
And these numbers here really show you that push and pull. The price-to-book and price-to-sales ratios basically suggest the stock might be undervalued, that it looks cheap compared to its assets and its sales. But then you look at that return on equity, and yikes, a negative 44% shows that it's just not using its money efficiently at all. It's burning cash. So let's lay it all out. On the opportunity side, this merger could be a game changer.
opening up powerful new avenues in blockchain, and of course, it gets them back on Nasdaq's good side. But the risks are just as big. This stock is going to be a roller coaster. The fundamental problems, not making money, shrinking sales, are still there. And this is a huge one. The deal means open world shareholders will own 90% of the new company. So if you were an original VerifyMe investor, your piece of the pie just got a whole lot smaller.
And that really brings us to the ultimate question here. This merger absolutely saved VerifyMe from falling off a cliff and sent its stock to the moon. But was this the start of a real long-term transformation? Or was it just a temporary lifeline that's kicking a bigger problem down the road? The only way we'll find out is if this new, combined company can actually fix the issues that got VerifyMe into so much trouble in the first place.